Welcome to Trade Ideas. I'm Jake Merl, sitting down with Chad Morganlander of Washington Crossing Advisors. Chad, great to have you back on the show.
Thanks for having me on, Jake.
So you've been on the show a couple different times over the past 6 months, and you were last here in February with a bullish thesis on bonds. You said the 10-year Treasury would fall below 225. You pretty much nailed the downturn over the past few months. Can you please briefly review what macro factors you were looking at to make that call?
So, Jake, it was really quite simple. We have a call out that global growth was going to moderate and in particular on the emerging market side. Also, we thought that the developed market side, in particular the Eurozone, was going to continue to struggle and inflation expectations were going to continue to drop. Also, the third component of this, and I think that people are underappreciating this, Jake, is that yield differentials do matter. And now that you continue to see German rates now on the 10-year at negative 20 basis points, that could continue to be perhaps a gravitational pull lower.
So what's your current view of the global economy? Do you think this slowdown is going to continue?
Yeah, look, you don't need a global recession or a U.S. recession for the 10-year bond to go down to 175 or particularly 150. Like I mentioned before, it's just about yield differentials and as well about EM. We continue to believe that you're going to see a perhaps additional rally within the bond market where yields go down across the curve. Overall, that could happen in particular in 3 months or 6 months, but also our intermediate viewpoint, which is a year out, is that you'll continue to see lower yields overall in the United States.
So we've already seen this dramatic move down almost to 2%. Would you be entering at current levels, or would you be waiting for a pullback to get involved with bonds?
So if you do see a pullback of 5 or 10 basis points or 15 basis points, we would add to our existing positions. If you're new to the trade, we would perhaps hold off. One of the startling things that is happening here is that you're not really seeing a tremendous amount of financial stress within the system right now. You're not seeing credit spreads gap higher or a disorderly CLO market or equities really plunge. This is all happening based off of, we believe, this perception that inflation and credit growth on the EM side, China, will just moderate or actually decelerate rapidly.
So within this disinflationary environment, are you looking at any other asset classes? I know you've been bullish on the dollar. You were bearish on emerging markets last year. What are you looking at now?
So we continue to be bearish on the EM side. In particular, I know that there's a lot of hope that there'll be fiscal stimulus that comes out of China. Even if that happens, we believe that will be short-lived. We believe that within the Chinese economy or this financial system, similar to another contributor that you have, Kyle Bass, that they're going to continue to struggle. In particular, we think credit growth there will be somewhat sluggish overall. And as a matter of fact, we may see it actually contract over the next 3 years. That will have enormous impact on demand, aggregate demand, global aggregate demand. So this right there is a stumbling block for, we believe, investors that think that yields have to go higher. Until they can answer that question honestly, where credit growth is going to come, ex-China, then I think that the bond bulls will continue well over the course of the next 24 months.
So would you be shorting emerging markets here, or would you just be betting on bonds?
So we're long-only portfolio, but we would avoid EM. For a macro hedge fund, you may want to look at certain parts of the EM on the EM side, on different sectors that are over-levered, too short. That's not what we do. Also, we would avoid potentially high-yield bonds at this point, because if commodity prices drop based off of the global backdrop that I'm talking about, then you're going to see perhaps some difficulty within some of the highly levered oil and gas, as well as other sectors that are dependent upon a ever-flowing credit system that is nice and tranquil. Again, we started our team, my partner and I, we do this work, and we really believe that you have to just be careful at this point within the economic cycle here in the United States and also within the global credit cycle. Just be cautious. Don't be a cowboy.
So would you be staying away from just EM equities, or are you also staying away from EM bonds and currencies as well?
Well, this is a funny thing to think about because, of course, EM equities for us would be something to avoid. But even EM bonds, in particular within China, I know that there's a lot of esoteric instruments that private equity firms are buying. I'm just trying to kind of square how you're going to get that claim against that asset if things go belly up within China. So we would, again, for more sophisticated investors that are poking around in China, ask yourself, how am I going to get that claim against my asset if there is a major trade disruption or maybe a major credit decline? I would be much more cautious at this point. Again, not overly bearish here in the United States, but you just want to start slowly or move your money to more dollar-denominated assets that are more steady Eddie and predictable.
So you're not calling for a recession. You're just saying this is more of a continuation of the slowing of growth, right?
Yeah, well, this is a global deceleration of growth going from a three handle, I think at the beginning of the year, the IMF had it at 3.7, down to 1.7, could actually feel like a recession in regard to business trends, trade volume, and whatnot. We're not calling for a recession right now here in the United States over the course of the next 3 to 6 months, but we can see a pronounced slowdown, which will, we think, push the Federal Reserve to become much more dovish over that period of time.
Do you think they're actually going to cut rates in 2019?
Yes, cut rates. We don't think that they'll hit the panic button until they start to see financial stress within the system. I think that there are 3 mandates. Of course, full employment, inflation mandate, and the third mandate is do no harm and make sure the credit markets and the overall U.S. financial system is quite tranquil. And although they don't mention that, they certainly, or that's not, that they strongly signaled that in particular yesterday with Jerome Powell speaking.
So what would you say is the biggest risk to your thesis?
Well, the biggest risk is that China continues to grow. Credit growth becomes quite ebullient in other parts of the EM, on the EM side. Inflation expectations start to improve, and that could, of course, derail my whole bond, our whole bond or fixed income outlook. Also, I would say that if you get fiscal stimulus within the Eurozone, that's quite pronounced, which we don't forecast will happen as our baseline, that could also perhaps juice up the global economy and give at least a second wind to fixed income in regard to rates going higher and in particular some risk assets moving higher. Last thing, I think, is the Federal Reserve. If the Federal Reserve starts to really become dovish, they start to really extend on their balance sheet again and drop rates by not 25 or 50, but 100 basis points. That could also add to that speculative fervor that we've seen in the past.
Chad, can you please break down this thesis in 30 seconds?
Global growth is decelerating. We continue to believe that to be the case, in particular within the emerging markets. Even if you get a trade deal, long end of the curve, we continue to believe is going to be attractive, even with this terrific move lower. And investors should perhaps start to become much more circumspect about the risk that they're taking. Either you be a long-only retail investor or a global macro hedge fund that's utilizing derivatives.
Well, Chad, that was great. Thanks so much for joining us.
Thanks for having me, Jake.
So Chad is bullish on Treasuries. Specifically, he likes buying the 10-year Treasury at current levels and thinks the yield could hit 175 over the next 6 to 9 months.